Hi, I'm Jeremy, head technical analyst of the RSIguy.com. Anyone that knows me knows that I'm an incredibly positive person. I live my life in gratitude, compassion, and with an abundance mindset. What I'm about to show you, unfortunately, is not positive, but it's a narrative that must be paid attention to, as it's rooted in facts, which by the end of the video you'll see are undeniably alarming. There are super bubbles around us everywhere, and I believe it's an incredibly important time to put this information out there for you all to see and understand. If you're interested in trading and learning how to see the markets for yourself, head over to the RSIguy.com, where I have the most comprehensive technical analysis course out there and include my proprietary RSI system that is unlike anything you've ever seen. For now, like, subscribe, and let's dig in. So if you've ever had that uneasy feeling that something just isn't right with the economy, you're not alone. It feels like everywhere we look today, there's signs of trouble. Wages that never seem to catch up, rising debt, and prices that are spiraling out of control. Look at what you're paying for eggs right now. So I want to dig in and take an honest look at what's happening and how it affects us all. Let's start with the median home prices in comparison to household incomes. So on this particular one, I started in 84 because that's where we really started as far as the chart goes for average household income. And in 84, the difference in home prices versus income was 33%. So you can see right here to here, we've got 33% difference. So between, really call it $60,000 and $80,000 for 60,000 income, 80,000 for the home prices. And what you can see is you've got this very slow moving line right here that's called our income on a national average. And then you've got this killer line that goes up. This looks like it'd be great if you were in it, but you know, a lot of people aren't. There's a lot of renters out there, right? And I just want to show here at the last 2 years since COVID, we had a massive increase in home prices, as everyone knows. A move that's really not sustainable in any market. So what happened here? Well, obviously everyone was stuck at home. People started thinking about those investment properties. Hey babe, we can buy this property down in Florida or wherever, destination, and we can use it for income. And right now, they're probably doing pretty well with it. They're probably sitting at 80 to 90% occupancy on those income homes. At least they were for 2 or 3 years. And now we're probably seeing a little bit of that falling off. The first thing, if we do get into a recession, that people are going to cut are vacations. And what's that going to do to Airbnb, VRBO? Well, people aren't going to be able to rent their places. If their occupancy all of a sudden goes from 80% and it ends up down at 40%, they're not going to be able to afford those homes. And they're going to say, we can't cover the payment on this thing, so we have got to get out. And this is a whole nother function of what could spiral this thing down. I want to throw this, you see two trend lines, like this one's in outer space right here. So I've got on log, and I want to throw on, I had logarithmic, and I want to throw on linear on that. So you can actually, linear is going to give you a much bigger view of what's actually happened. We can kind of go back and it was nice and smooth. And then when you throw it on linear, it is really shows you how parabolic this move was in particular right here. Log scale actually kind of flattens everything out based on percentage as opposed to actual dollar ticks. So log scale will flatten things out. It makes it easier to look at things over time on a percentage basis. But if you really look at it on a linear scale, this really shows how scary this is. And you have this really nice trend line on the bottom. And if we get back to here, I mean, that's a major housing crash. Do we need it? Probably. I mean, this is, we're talking about, between interest rates, your income levels, and then where you are on housing prices, we're looking at 520% difference between the average household income today as it was back in 1986 at 33%. That is a huge gap. So why can't people afford to get homes now? This is a good reason. So, unfortunately, I think when this thing unwinds, we're starting to see this for sure in, the home builders at this point in time. And in my particular market, I'm actually seeing brand new homes going for $50,000 less than homes that have been established in here for 30 years. And not only that, they're actually offering some real incentives on mortgage rates. So like some are doing 4.5%, 5% for 30 years, where you're going to pay 7.5% on that loan for a home that's 30 years old. So it's definitely a warning sign. And I had this line drawn on for years now, since 2022. And although it's not following here, if we go back to the log scale, it's still holding up, which is kind of crazy to me. But all the markets are elevated, and I do anticipate seeing something like this and a return back to kind of median, at least, in the future. So that's definitely something to be wary of at this point in time. All right, let's jump into just our general expenses in life, right? Food prices. We look at these. Obviously, we had a huge spike, continued through 11, and we're kind of flatlined here now. But the crazy thing is if you're going to tell me that the price of eggs, the price of a bag of potato chips in just the last 5 years they're double what they were before. So I know that this is really the chart that kind of plots out the price of these things, but I can tell you, as a consumer, I'm probably paying way up here as opposed to where it's saying that we're at. I think we all are. You go to the grocery and you're just like, wow, $8 for a 12 pack of Coca-Cola, right? My kid drinks a lot of Coke. So it's a different world that we're in. And it's been spurred over the last, since 2020. So you've seen this major increase in food prices. We're not going to harp on that one for too long. But we are going to look at CPI. This is all kind of relative to, again, this is log scale. Let's flatten it out and do, that's kind of flattened out. But let's look at, I've been trying to go off of 1990 on a lot of these charts just to give us a good relative spot. So if we look, this is the 50s. We kind of had this slow growth, and then since that 90 area, this thing has just taken off. So this is the CPI data. This measures, consumer price index, what you're paying across the board. And if you look at producer price index, the chart's the same. I mean, producers are paying more money. Everything's becoming more expensive because energy costs are more expensive. I mean, everything in your life is more expensive. So, if you look at the difference in the growth, we're, at 119, 120 something around 1990, and now we're almost 2x that at this point, 3x that at this point. So it's a big difference in what we're paying. And again, I'm going to continue to go back to your median income, which has come up 33% since 1986, and it's just not in line with where we're at. So we look at the S&P here, and we go back to 1990 area, in this range here, and you look at how parabolic this market's gone. Even with this ABC correction, we had this 3-wave correction on the bigger scale. You're really looking at a massive run. We're talking thousands of percent since 90. 1,674%. If we look back, the market we're going to go linear on this, because this just changes your whole perspective to show you what I'm talking about. So let's go back and try to find that 90 range. It's right in there. Let's see. There you go. So as I told you, log scale flattens everything out. Linear shows you, tick by tick, dollar by dollar here. So that's a massive difference. And it really gives you the thrust and the, oh my gosh, look at what's actually happened since 2009. This was massive parabolic move. So these kind of things all adding up together are things that we've got to pay attention to, because when the bubble pops, it could be really, really ugly. The mean down here, like this is your support down here, right? Because it was resistance here, we got through, and it's been nothing but up. We had 2020 come down. We had 2022, which was a small correction. But when you look at this, it's kind of a pretty perfect 5-wave move at this point in time, and it looks to be relatively over. What I would be looking for is, as you can see, I've got this drawn on here, and I actually am looking for a little bit higher high on this, and then that's kind of where I think things will end. You'll see everyone get really bullish again, and we'll have this kind of blow off top event that's going to really, really come down quick. We call that a Wyckoff distribution. Richard Wyckoff died in 1934, but he saw the markets and came up with what he saw over and over again happen in the markets. So, I feel like this last push we just got to was a UT, and you can see if you go to wyckoffanalytics.com, it'll explain everything in here. But I'm still looking for this upthrust after distribution for us right now. I still think that we're going to get this UTAD that's going to give us this higher high. It'll give us negative divergence on our indicators, and you'll actually see that kind of be in the top, and then that's where we get this blow off top effect and everything coming down. And you can look at the charts. This is the bottoming effect, this is accumulation through here, and then it takes off. This would be distribution, and then it actually takes off to the downside. So I really feel like that's kind of the phase that we're in, because I don't understand how they can keep it up much further. When you look at this, there has got to be some sort of correction. I really wish they had let it go in 2022. I think it would have made for a lot softer landing than what we're about to experience right now. So again, I'm a super positive guy, but I'm just looking at the alpha. I'm looking at the information that we have here. When we take a look at the inflation rates, they actually did a really good job since 90s, like even within the 80s, mid 80s. They've done a pretty good job of keeping us at this 2% baseline, right? It's been a little bit more elevated, I would say, than it has been under. So, maybe that number ends up being 3%, 3.5% that they've kept it in, but they've really kept it in this range pretty well. And obviously we had this big shoot up in 22. If you look at the RSI on this, you're actually seeing a very substantial trend line that goes back to 82. So it started here, we got a touch here, we've got a touch here, almost came down to it. We just touched here, and now we've got what's called divergence, which means RSI is higher from here to here, and we've got lower from here to here. So my fear is that we actually might get something that looks more like this and this soon, that this would just be, now if we end up having this thing move up and we get inflation rates that are elevated while the markets are coming down, that's going to, and employment comes down, that's going to be what's called stagflation. And that's where, we can really get ourselves into a place where a lot of people are going to hurt. So that's definitely something to be aware of. But I want to show you, if the average at 2% is what the Fed is shooting for, I went ahead and did a chart because I wanted to look at, okay, so if a 2% inflation rate, let's just say since 1990, because that's what we used for our baseline, 63,800 was what the average consumer was making, average household was making at that point in time. So at 2%, the number should be $127,000 with change at this point in time. And well, it's not. So to be honest with you, the number ended up being 0.65% that the income has come up over the years. So the division between people that have, a lot of money in this world and people that are in this boat is significant. And it's that the wedge is actually getting quite a bit bigger at this point in time. So, this is what average Joe and average Jane should be making, and this is what they are making. So, even at this rate right here, you're still looking at houses that, are almost 4 times almost that much. So maybe it's 3.5%, but that 419,000, probably 3.5% or 350% higher than what it is. So, but we're not there. We're at 520% difference. So let's go back to our federal debt. This one's not fun to look at either. So using that 1990 as a baseline, we're sitting at $3 trillion in federal debt, and then you can just see how parabolic this thing's gotten. And you look at, what's happened since COVID, right? This is just absolutely parabolic, and that's scary because this one doesn't have to correct. This isn't a normal market, right? This is a function of printing money, government debt, overspending. So let's look at this chart that actually gives you, sorry, not this one, at the U.S. debt clock, right? So I actually have this set right now. I think it was at 1980, but usdebtclock.org, this was 1990. So I want to do apples to apples. So we're right around that 3 trillion number, and then we go to 25, And you can see we're 10x that number at this point in time. It's a little scary. I mean, one thing that I have seen is that we went to 2029 before. This number was closer to 60. 60 trillion. And it's actually come down a little bit. So maybe they are tightening the purses. Maybe some of the things that they're doing are helping. But at that same time, I mean, how sustainable is this? All right, getting back over here, we're going to look at the money supply, because this is really important. And if you think about the societies that have gone down in the world, the Venezuela's, Hungary, Zimbabwe, Yugoslavia, the countries that have got themselves into massive hyperinflation was because they overprinted. And I'm talking, what's the definition of hyperinflation? They want it around 2% for us, but we would be looking at, I think, 50% or higher a year. It would put us in a hyperinflation scenario. So that would be really scary if your dollar only bought half of what it did before. And this is, the way to do it. We're on linear scale on this, so we can see that, it was pretty slow. And then we had from 1990 here over to when 2007, 2008 market crash happened. And then you see what they did to get us out of that. And we got, in a very short amount of time, 185% of the amount of money, US dollars were printed. So the BRICS nations have a very vested interest in wanting to take the dollar down, and they don't want it to be, the currency of the world at this point in time. And this is exactly, if they band together, this is exactly the kind of thing that happened in these countries, the Venezuela, Hungary, Zimbabwe. I mean, this is really scary stuff. You can't print yourself out of problems. If you did in your basement, you'd go to jail for the rest of your life. But it's legal for the Fed to do it. That always boggles my mind, right? It just, something that would be a massive felony for us is something that's common practice for the Fed. All right, and then I just want to go into the last one here, and that's going to be our total household debt balances at this point in time. And I want to point out that TradingView actually has this wrong. The number is $18 trillion, not billion. That's how much household debt we have. So that's, when I looked at the chart, I'm like, wait, no, it's higher than $18 billion. I know it's significantly higher than that, because I think we increased last year alone 96 billion. So if we look at this, which is the Federal Bank of New York, and we actually look at their chart, this is the household debt right here. So non-housing debt is in red, and then the housing debt is in blue. So this, kind of shows you the gap. I mean, the last time we were in, the highest high that we had ever, if we go back to the chart, was with 2008. And you can see how far we are over this. And again, we're talking trillions, not billions. So a wise man once told me that the way to quantify the difference between a million and a billion was a million seconds is 11 days. A billion seconds is 33 years. And I haven't even calculated the length of time on a trillion, but you can imagine the difference between these billions and trillions. It's staggering. So, those are all factors that really scare the crap out of me at this point in time. I mean, everything is so elevated at this point. We've got to be paying attention. So is there any hope? Possibly. We could possibly fix it, but it won't be easy. Some things that could help would be bringing manufacturing back home, reducing the dependency on imports, and boosting American production. We've got to have massive debt management. I mean, we've got to be aggressive on this, both on the consumer and the government level. I mean, those numbers are real. And the only way that we can right this ship is to absolutely be aggressive on our debt management. And we're paying more in interest right now on our debt, $36 trillion in debt, than we're making in taxes. That's just the interest alone. We've got to achieve energy independence. We've got to invest in our domestic energy, stabilize our prices, and reduce the reliance on foreign sources. So we've got to have a responsible monetary policy. We've got to end the reckless money printing, and we've got to carefully manage these interest rates because we're at that peak right now. We're at the bubble on everything. I think sustainable farming is going to be really important for the next 50 years, and being responsible in the chemicals that we put in our ground in the United States. So none of these are small tasks. They're going to require bold decisions and real leadership. And without quick action at this point in time, I feel like we're in for a very painful economic reset. What that looks like, I don't know, but I'm not interested in finding out if we can figure out ways to do it, and we need to move quick. So my final thoughts is, as we're facing these economic crossroads, the combination of stagnant incomes and these skyrocketing costs, the massive debt, and the shifting global dynamics that we've got in with the BRICS, it's all created a dangerously unstable situation. So we do need to take bold steps at this point in time, or we're going to risk that crisis that could dwarf anything we've ever seen before. So the big question is now, will we wake up and act, or just wait for that bubble to burst? Hopefully the next video is a little bit more positive, guys, but I appreciate you sticking with me if you made it till the end. It is a scary place, and it's important to be aware. You crawl down the rabbit hole. Most people don't want to know. Most people are stuck behind their, as my wife calls them, glow boxes in their phones and TikTok day and age. And I don't know. I'm one that likes to pay attention, so that's where we're at. Y'all take care, be good, and hopefully there's a glimmer of hope and ray of sunshine somewhere on the other side. Take care.